Hello, investors. Thank you for joining us. So today we're going to talk about investment for beginners. This is episode 3. We're going to talk about two different overarching themes, which are theme diversification, and then we're going to talk about whether you should really leave cash on the side. So my name is Michael from Deep Value Returns on Seeking Alpha, where I run a premium newsletter, and we can talk about types of investments that I pick, but normally I come out and I highlight a hybrid portfolio of stocks with half of it being value names and half of it being high growth names. The idea being that you're exposed to different styles of the market. And over to you, Manuel.
And I'm Manuel Maurício, and you can find all my work over at allinstocks.com. So let's do it, Michael. How are you this week?
So I'm very excited. So one of the things that I've noticed is that if 2020, you saw that there was so much of a bull market in 2020, I've seen that in 2021, there's been a divergence. But actually, if we kind of unpick that slightly, you can see that from February, actually, I think it marks the 17th of February, from the 17th of February into May, many stocks have sold off slightly. From May into the summer, stocks rallied. And then really since the back end of July, there's been a divergence. And some names have just fallen by the wayside, and other names have really, the market has just kind of really picked them up. And the market has just been kind of sieving through what is dramatically underpriced, and markets have been kind of getting in, rushing in, and the rest of it, the bulk of it, has just kind of continued to tail off slightly into September. And what I was going to bring to this podcast today was about the idea of theme diversification. So let's say, for example, one idea could be consumer stocks. Okay, consumer stocks are stocks that everyone kind of uses around the household. You have, let's say, soap, detergent to iPhones. You know, everything that you kind of know as a brand is probably in some way exposed to the consumer sector. And then you can look at another theme. For example, advertising stocks. Advertising stocks would obviously be the likes of Facebook and Google. And you can have some social media platforms. And within that, you might even break that up slightly. And you can consider something like the Trade Desk that has great exposure to digital advertising. Another sector could be, for example, cybersecurity names. So these are kind of stuff that is supposed to protect you as you work from anywhere. Another operation could be SaaS productivity. So these are different things. And what seems to happen when a new idea hits the market is not very discerning. They just get really infatuated with a certain idea and they latch on. And for the first, let's say, 12, 18 months, the market is not very discerning versus what is a high quality business with a lot of staying power and what is a low quality business. Buffett's quote to this is that the tide lifts all the boats the same. So there's just not a lot of divergence. And you can see this in cannabis stocks, so whatever sector, EV, electric vehicles, whatever you want to look at. At the first start, when the idea kind of starts to get some traction, the market just picks it up and just runs with it indiscriminately. Only later on in the cycle, 12, 18 months out, the market starts to be a bit more kind of, okay, this investment is too expensive and not worthwhile considering, and this other investment is actually expensive, but is a reason why it's expensive. You can look at streaming companies, you can look at whatever, it doesn't matter. And it's this idea that I like very much, is when in that same alignment, when certain themes get thrown out with the market, is when that sector is totally out of favor and unjustifiably so. And if you're able to pick out the one or two names that is unjustifiably cheap, and you're able to pick it up when people don't want to buy it, but you don't want to go too aggressive too quickly. You start with a small position, you build it up slowly, but when you see that there's an earnings result where the group leader, the best leader in that space, has a very strong result, and the market says, okay, oh, you know what, we were kind of wrong on this, and the share price rallies, you can get in even after the next day, the next week after the share price has rallied significantly and it's up 50%, you can get in then and you can continue averaging into your position, and you will do quite nicely over the next 2-3 years out. I'll give you another example, a current example that I just looked at the other day. In the buy now, pay later space, you can look at a company like Affirm. Affirm was one of the hottest IPOs. Everyone, like the PayPal mafia, that was the headline for everyone. And everyone's like, oh my God, this is going to be like the new big thing. And then it kind of just fizzled out. Okay, people were just like, this is very expensive, I'm not touching this. And buy now, pay later, people didn't want to touch. But as you looked at a lot of the companies underneath that, actually every big company was trying to get involved. You look at Apple with Apple Pay, you look at Google Pay, you look at PayPal with Pay Later, you look at Square purchasing Afterpay. So you could look at Klarna doing an IPO in the next several months. So companies actually were catching on that this could possibly disrupt the traditional rail guards of the industry. You got your Visa and your MasterCard. If there's a potential to disrupt that market, people are just like, oh my God. So the companies were doing really, really well trying to kind of get attraction in that space, but the underlying companies themselves, so for example, Affirm, the investors didn't really care for it. And then all of a sudden, Affirm says, actually, we're joining up and having a pilot scheme with Amazon. And that was not within the earnings result. That was 2 weeks before the earnings results. And the share price rallied about 50%. And then the earnings result came out. And the stock rallied another 25% or so, possibly a bit more. And this is the idea that if you're willing to kind of follow different themes, sometimes you can kind of unpick what is the leader in that space and pick out the best one in that space. Now, a lot of the times the arguments that I hear from investors is that stock is too expensive. And every company, when it's starting off, if it has something worthwhile, it starts off expensive. It's only much later when the company is 25 years old or so that the company starts being what value investors say, oh, that's a cheap stock, but you've missed out like everything else. So an example that I can think of, like, oh, 2 examples. So one of them could be Alphabet, Google, it's approximately 23 years old. The other company would be Netflix. So these 2 companies, for example, are priced, I don't know off the top of my head. So I think Netflix is priced at approximately 8 times forward sales. I think that Google is approximately 9 times forward sales. So for all intents and purposes, value investors would say, okay, these are cheap companies. Value investors would be like, okay, I want to buy this company because it's making a lot of earnings. I'm not paying a lot for those earnings. But a person has missed out in more than like 2,500% of appreciation over the last 15 years. So yes, the stock is a lot cheaper now, but it was very, 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 very expensive to start with. And just before I kind of pass it over to Manuel, I just want to say one more thing here, just briefly. What I find fascinating is that when I look at a company like Netflix, Netflix is approximately a quarter of a century old now, and it still doesn't make a lot of free cash flow, like clean, actual free cash flow. It kind of makes it about $1 billion, but you know, for all intents and purposes, this is a 200 billion market cap company, and it doesn't really make it. But what investors are pricing in and have been pricing in for the past 15 years or so is the perception of where the free cash flow will come from over the forward-leaning 5 years. So it's always, the market's always trying to lean forward and kind of estimate the predictability, the stability, and the visibility of the free cash flow over time. So that's what the multiple is. When you're buying, let's say, a multiple of 6 or 9 times or 12 times or 50 times price to sales, you're trying to estimate what the future free cash flow will be. So going back just to Affirm here, so Affirm is a company that people will say, okay, it's very expensive right now. But if you give Affirm another 10 years, the multiple will probably come down. It'll be more of a kind of a cheaply valued stock, but investors may or may not, I don't know how Affirm plays out, but the stock will have most likely rallied significantly in that time. And my point is that it's quite difficult to have an idea of what is a reasonable valuation for a theme, a sector. It's quite difficult. But what you want as an investor, so I'll give you a different example. So within digital advertising stocks, these are stocks that are growing at a reasonable rate. you can think of like the Trade Desk. There are some other ones like Magnite. These are, you can look at social media platforms. These are growing at a reasonable rate, highly profitable, but the investors right now don't want anything to do with this sector because everyone's afraid of two things: cookies and privacy changes from Apple. So the ability to not being able to track and trace you, Manuel, online is not very rewarding for an advertiser. An advertiser wants to know exactly what Manuel is doing on Friday night. They want to know how to best target this consumer. And investors are kind of worried how that's going to play out. So by being invested in just one thing, for example, advertising stocks, you don't know when the market is going to re-rate, and you don't know when the market is going to say, actually, we've been valuing this side of the space very cheaply. We should be pricing it much more expensively. And it's difficult, even if over, let's say, a period of 10 years, the valuation of a company approximates intrinsic value. Over a period of, let's say, 3 or 4 years, it's really down to perception. And you can look at another example, a very famous company, Berkshire Hathaway. So Berkshire Hathaway goes through these periods where it doesn't do much. And then there's a period where it just jumps and soars. And then it kind of doesn't do much for a while. And it's really difficult as an investor, if you're just kind of invested in a few buckets, to kind of have that stamina to really kind of hold on to the investment for such a long period of time. How do you kind of think about sector in your portfolio, Manuel?
Well, when you told me that, first of all, my internet connection is failing. So if it fails, just pause the recording and I'll connect the cable. When you first told me that you were gonna talk about this subject, theme diversification and theme investing, I thought that I had not that many insights, and then I read something and I started thinking about it, and there's a lot to talk about here. Theme diversification, and I would like to ask you some questions as always. You can do it like with a part of your portfolio. You can do it with your whole portfolio. From my point of view, right now, I have some theme concentration on a few themes with parts of my portfolio, right? And I remember Buffett in I don't know which decade, he invested in the advertising companies, agencies, and invested in a bunch of them, not just one or two, which leads to another great question, which is, when you look at let's say the advertising business or whichever, it doesn't matter, will you invest in the best one, or will you, and you can, first of all, and you're looking at that sector, at that industry, and you believe, your research has led you to believe that the whole industry will go upward and to the right? They will sell more in the coming years, etc. They will profit more. Will you invest in the best one, in the second best one? Because usually the best one will be more expensive from multiple perspectives than the second one. Will you invest in both, in the three, in the whole sector? So those are a lot of questions to think about. And each investor will have his or her own views on that. I usually like to invest in the best one. It's more expensive for a reason. But I totally understand the investors who tend to invest in the cheaper ones rather than in the best ones. It's another view, and I'm willing to change opinions or to evolve my opinion with time. You've talked about Netflix versus Google as well. I wouldn't have bought Netflix if I had seen it 5 years ago or 10 years ago, because of the free cash flow. But I would have, and I have bought Google because of the free cash flow. So one is a cash flow machine, the other one is a cash burning machine. And I'm not saying one is better than the other. It's just my way of looking at things. And I've obviously been wrong for the past 15 years on Netflix and missed out one of the best stocks ever. So
true. Me too.
But the thing is, and I'm going to Buffett here because the guy knows something about this. He invested in Apple when it was already mature, And we went, for some reason, the investing community didn't like it. So when you say that you have missed out on Netflix or Google until they've become mature, and I'm not saying that, but this is a disclaimer. I'm not saying my views are better than other people's views, but but you can still invest in mature or at least not so young stage companies. And I'm the guy who likes microcaps. But you can invest in not that early stage companies and still come out very well. Absolutely. After they've proven their business model. And let's say, I don't want to get into specific companies, but let's say Apple is shifting its model, or another one, a good example is Microsoft. It shifted its model from selling licenses to this SaaS business. And no one saw that coming, and I might be wrong here, but no one saw that coming. And it was a mature company, and you could have made a killing investing in Microsoft a few years ago. So there's always that opportunity. And someone would say, oh, but you've missed the Microsoft, like I don't know, thousands of returns. Okay, that's true. But I think it would be easier, or at least not as risky to invest in Apple a few years ago and in Microsoft a few years ago. And all of this with hindsight bias, I know.
Yeah. No, but it's fascinating, isn't it? It's absolutely fascinating. So a great example with Apple, absolutely outstanding example. So we as investors always try to go for the under followed, but right there, like on your wallet, in your pocket, you could just, the Apple investment, it would have done so well. If you think that the average investor is trying to beat the market, and the market, let's say there's approximately 10% a year, and you're trying to do 12 or 14 or 15%, Apple just kills that in any period of time. Looking back, like pretty much maybe the odd year that it doesn't do 15%, but it's just a compounding machine. So yeah, I mean, it's very, like, as investors, we always kind of go for something that's like slightly better, but like sometimes these names are just impregnable free cash flow machines. What's more, when sometimes I think we've discussed this in the past, but over time, the amount of intellectual property that doesn't show up on the income statement can allow you to compound at such a high rate of return, like in the case of Apple. So yeah, where does Apple's lawyers teams show up on the balance sheet? It doesn't show up on the balance sheet, but you got some of the best lawyers on the planet working there, and like that doesn't show up on the balance sheet. So how do you quantify that legal team? How do you quantify that intellectual knowledge for example, at Google, or how do you quantify? There's certain things that these businesses that they are huge, like we're talking about $1.5 trillion, and it's very difficult to quantify them and say that the race is over, So
let me just, there's a caveat here with Apple, which is the business didn't actually grow that much since Buffett bought it. Let's say in 2018 or 2017, it was the multiple that re-rated or went higher. It was not the as much the business as it was the multiple going higher. But still, other stuff that I would like to talk about from what your theme diversification versus concentration. There's good stuff and bad stuff in theme diversification. Good stuff, you can, when you understand the trend, let's say advertising businesses, you can get.
So just let me interrupt. So about Apple, so like if you look at, I don't know the numbers off top of my head, but I'm sure if you look at the EPS number, the earnings per share, I'm quite confident that it's compounding at 15%. I'm fairly confident that, because they just buy back so much of the stock, don't they?
But I was just checking that from in the EPS in 2018 was $3, and now it's $3.30.
Unchangeable, actually, remarkable. Yeah, sorry, I thought that. No, I was just, and yeah, you're absolutely correct, and it's just like really the bubble that's kind of pressing everyone forward. Yeah, I suppose interest rates are low, people have to buy an ETF or something similar, and everything just kind of becomes like a virtuous circle,
And Buffett bought it, so it helps for for it to go up, right?
But he's already sold a portion as well, hasn't he? I think as well.
So let me ask you, do you do the theme investing? Like, how do you do it in your personal portfolio?
So I don't want to, for example, just have, let's say, exposure to advertising stocks. I try and pick out the best in the sector like you did. And I know that it's more expensive, but what you're trying to do as an investor is, the first one is Buffett's rule number one. You don't want to lose that capital. So it's much better for you to go and put where the odds are more in your favor. Yes, the multiple is higher to start with, but you have a much better quality of the management team underneath it. So for example, the leader in that space, more often than not, has a founder leading the business. The founder owns a significant amount of stock in the company. So they are very much in the disrupting business in that space. So they are so many years ahead of those other businesses that are just like Me Too businesses. They're just copying. And it's difficult to kind of, from a valuation perspective, to pay up for the best of the best. But there are certain things that you can't quantify. And I kind of, as we've discussed in the past, I've kind of migrated over time in my thinking, but this is where I'm at right now. I just believe that it's so much better to go for a safe investment. In 2021, I have made some dramatic mistakes, like absolutely killer mistakes. And these mistakes that I've made is by trying to buy something cheap because I couldn't understand, quote unquote, the accounting. I was like, oh, I'm so smart. I can figure this out and I can figure that out. And I go through it and I put it in a spreadsheet and I think about it and I compare and contrast this with the peers and this. And there's no reason for it to be cheap, but there is a reason why it's cheap. And when I've really taken a hit in my portfolio, it's been because I've tried to outsmart everyone else. And over time, this is where I'm going towards. Is just, I don't want to be pretending that I know more than anyone else. And I just want to kind of position myself into the best businesses. Yes, I'm paying a bit more, but you can go into that sector when that sector is out of favor with investors. You don't have to go, for example, into EV vehicles, like electric vehicles, when everyone else is buying it. If everyone else is buying it, maybe look to something else that people are not buying right now. And at some point, things fizzle out. And then that's a kind of interesting point to kind of get involved. You can look at, for example, fintech, like credit services with technology on top of it. So sometimes these things kind of, people don't really want to get involved in them because of XYZ. I can give the example of advertising stocks, and everyone's worried about privacy concerns right now. But so you kind of do the work right now. That's what the way I describe it is like an Olympian athlete. You do the work every single day. Every single day, you show up, you do the work, but you don't have to invest. Everything that you do about investing is on the run up to the day that you do the investment. That's when you do all the work, is the preparation. The moment you buy that first share of the business and you become the business owner, the universe has a way of kind of teaching you a lot more about the business, but it can only supplement what you've done as the foundation. And when it comes to investing, you're much better off buying what other people don't want to buy right now. But at the same time, to be humble enough to understand that the market is more often than not right. And if the market is out of favor with a certain space, give it some benefit. Say, maybe I'm not right. Maybe it's out of favor for a reason, and it might not come back for another 5-6 years. And I know that you have a much longer time horizon than I do in terms of when you buy your stock and when you kind of sell it. But I know from my own experience that if you kind of hold the stock and for 2 years, you just see that kind of going down, you're like, oh my God, you become overwhelmed. And it takes too much out of me conceptually. And when it comes to investing, yes, everyone wants to do the 15% per year, but you have to a little bit enjoy the process. And if every time you open the portfolio and you just see that your capital is shrinking, I mean, it kind of, yeah, I'm going to get there in the long run, but in the long run, you're dead. So you have to enjoy the process as well. So it's about what we say in the past, like the way that I do it is different from the way you do it, and the way you do it is different than the way John does it. And you have to kind of do what makes you happy, right?
Mm-hmm, mm-hmm. You've mentioned several things that I would like to talk about, and I think we're gonna take it to the next show next week, because there's a lot to talk about around this. You've never, just one question, you've never bought like a whole basket of an industry, of stocks inside an industry? No? Okay.
No, I think that typically if you're right on the sector, even if you bought the worst company, you're going to do okay, reasonably sane. And the same if you're wrong on the sector, even if you bought the best company, you're not going to do very well. So you might
Unless
as well.
You're talking about mining, because
Yeah,
the worst mining companies are really bad.
Mining a biotech, man, that's those are crazy. When you I live in the UK, so when I open Yahoo Finance on in the morning, it's always kind of like those stocks that overnight are just up 1,000% or whatever. And you see these biotechs, they're just kind of up 1,000, then you look at them 2 weeks later and they're back down 99%. It's kind of those biotechs. Yeah, I don't know if anyone actually makes serious money off them.
I have a few people coming to me before subscribing to All In Stocks, asking me, do you do biotech? I've seen this stock going up 10,000 times. And I was like, have you thought about the other 200 stocks that didn't go up 10,000 times?
Yeah, and then like 2 weeks later, that stock that went up loads, it just kind of fizzles out because they didn't get the FDA approval that they needed or whatever. It's like, it's too much. But that's what you have to do when you're investing. And when you're starting investing, this is something that investors don't really realize. Yes, everyone wants to compound at a reasonable rate, but it's actually important to do in a way that relates to your personality. And ultimately, this is not a get rich quick scheme. And you have to kind of have that vision to stay in what I call the 20-year investment trajectory. You have to be able to do this for a long period of time. This is not like you see on YouTube where the guys doing, like how to become seriously rich overnight. It's a long term. You have to kind of do it for many, many periods. And that's why I always say to everyone, you have to enjoy what you do. You don't want to get overwhelmed when things go wrong. So like I typically would like to buy the best company in that sector and just kind of, enjoy the process of owning that business. Okay, I think we're going to kind of wrap it up here, Manuel. Do you want to kind of say anything else?
No, just one thing. There's one guy, is English and he lives in Switzerland, called Rob Vinal. And he
is RV Capital.
He's known for being a quality compounder investor, and he runs a really concentrated portfolio. And I researched some of his picks. And the other day he invested in Salesforce because he was invested in Slack, Salesforce by Slack. And he was saying on his last letter that sales for him, it's undervalued, and that's the proof that there can be a giant in front of you and still be undervalued, even with all people looking at it and all the analysts looking at it. And he also invested in a company which is a elderly people village. I don't know how to call it.
Like a nursing home? Like a nursing chain kind of.
But these guys, it's in New Zealand and Australia. It's really like a village. So you've got the town center and the around there's a bunch of homes.
Like a resort, kind of like a resort.
Like a resort, yeah. And these are amazing businesses. I'll tell you more about them in another episode. And the guy invested in the best one. And then I went to research the best and the second best. Pardon me. And I was convinced, and the best one is more expensive than the second best. But it really, and then I talked to the IR people in both companies, and the IR person in the second best company told me that her mother was actually in the nursing home of the best one, and that told me, okay, this is what I should do. Invest if I am to invest in any of them, it will be in the best one, even if it's more expensive.
Yeah, ultimately, we have been indoctrinated to be value investors and to try and get the best bargain, but it's also an odds game. You want the odds to be in your favor. And I think that it's typically better to align yourself in a business that has high returns on invested capital. And this doesn't necessarily need to be just looking at the income statement. It's just thinking through, because for example, in the case of Netflix that we talked about, you look at that income statement, there's so many question marks, and there's been so many question marks that I've put about how they amortize those intangibles. It's like every single short seller has thrown everything at that stock for the past 15 years, and yet like it would have been a terrific investment. So there are certain things that don't show up, and it's the ability to put the odds in your favor. And sometimes they're so difficult to kind of really think through, you know, and quantify all these things. Okay, guys, I think that's pretty much it for us for this week. I hope that you guys will join us in Investment for Beginners next week. And yeah, I'll see you soon.
Bye.
Okay.